Hey everyone, and welcome back to another video for today. So in today's video, I want to touch on two companies, two different risk profiles, two companies that operate in different industries, and two companies where their stock is down between 30 and 50%. Now, the first company is a company I personally own in my portfolio. The second one might be included in the portfolio in the coming days. Remains to be seen what happens with the market. We've got some positive news from one of their biggest markets that they're operating in. More on that in just a second. But the first company I want to touch on is dLocal. dLocal has a market cap of $2.31 billion. Stock is down year to date 54%. Now, dLocal is a very fast growing company and a company that is actually profitable. It's profitable, it's growing faster than unprofitable companies. Now, right now, if you look at the analyst estimates, what's the problem? Well, the problem is profitability has been hit. Margins have been hit this year, actually last couple of quarters already, because the company is investing heavily in its business, investing heavily in the future. I always give the same example. We've seen this with Adyen, although Adyen, it was a very quick recovery. Adyen stock got hit, fell also 50% or so because the company was investing in the future and so margins was coming down in the short run. In the long run, of course, margin has already recovered. They've shown us their long-term roadmap as well, and so the stock has recovered quite quickly. With dLocal, they're still in that investment phase, and so margins get hit, and so the stock got hit as well. Plus, dLocal is a player in emerging markets, so it's always more riskier. But as you can see from the analyst estimates, sales growth is expected to grow very fast year after year, and EPS is expected to recover quite quickly in fiscal 2025, growing close to 42% year over year, and then another 38.5% in fiscal year 2026. Now, dLocal, although its stock has completely been obliterated, it's not like its business has not been performing well. No, actually, total payment volume, TPV, has grown quite nicely since Q1 2021. It has grown by 551%. If we look at gross profit margin, still sits at 40%. So yeah, overall, the stock has been obliterated, but it's not like the business has not continued to grow. If we look at some other metrics, total revenue since Q1 2021 has increased by 325%. Yes, it's true, there has been a small slowdown. If you look at free cash flow, since then it has grown, but of course that fluctuates a little bit, and right now free cash flow is coming down because of those investments. There's also some devaluation of some currencies in markets that they're operating in, for example, Nigeria or Egypt. More on that in a second. Then gross profit has grown quite nicely and has actually stabilized in the last couple of quarters. But as you know, this stock got completely crushed. That, in my opinion, is an opportunity. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comments with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, last quarter, these were the main results. So record high TPV in Q2, quarter-over-quarter profitability resumed amid impact of currency devaluation, merchant repricing, and continuing OPEX investments for future growth. As you can see, gross profit year over year is still down 1%, but quarter over quarter, we've seen a nice little rebound that's up 11% quarter over quarter, and adjusted EBITDA is up also 16% on that same period. I previously said that I think Q2 might have been the bottom because of this. So sequential improvement in gross profit margin and flat net take rate despite the headwinds of merchant repricing, devaluations in Nigeria and Egypt, and weakening across most emerging markets currencies, which is also why guidance was impacted. So as you can see, gross profit margin percentage quarter over quarter bridge is up. Gross profit over TPV is basically flat despite these headwinds. They also show us gross profit in the different regions that they're operating in, and here you can basically see the fluctuations, the volatility. So for example, Brazil, Q4 to Q1, gross profit has come down, but then has rebounded back in Q2. Argentina, gross profit was completely obliterated, right, from Q3 to Q4 in 2023, but now we're seeing a steady rebound quarter over quarter. If we look at Nigeria, same thing here. Nice rebound quarter over quarter in 2023, but then from Q4 to Q1 got crushed, and has now seen a nice rebound quarter over quarter. With Egypt, about the same story, some volatility there. We go up, but then we can also go down. So this is basically the risk that you have to take into consideration because of the markets that they're playing in. Sometimes quarter over quarter things will look great, but other times things can go down. As this company grows and grows, these fluctuations will be less visible and will hurt the company less and less. Now I did a quick reverse DCF here, basically looking at the growth rates for the local in the next 10 years, what it should be to justify the current price. Now, free cash flow in the trailing 12 months is $136 million. I put a terminal growth rate of just 2.5%, so that's lower than what you would usually put, I would say. A discount rate of 11% since emerging markets a bit risky, so we're putting 11% there. And then years 1 to 10, growth rates 7.5%, but I put this as the implied growth rate, but as you can see right here, year 1, assume growth of 0%. Year 2 and year 3, I'm putting the expected earnings growth rates for free cash flow, but of course those are the expected growth rates for EPS. I'm just putting those right here for earnings, so I'm putting 42% in year 2 and 38% in year 3, followed by that implied growth rate of 7.5% in the next years up until year 10, which brings us to an estimated intrinsic value of $13.42, which of course is higher than the $8.10 that we're at today. Of course, you can play with those numbers. I mean, this is a growing company. The implied growth rate of 7.5% is very, very conservative in my opinion, but okay, let's run with that. Let's have that margin of safety. And yes, I did change the first 3 years, so you have to take that in consideration. But overall, I still think that this company is a fast-growing company that is profitable. Yes, short-term headwinds or short-term investments that create headwinds for the stock, but that should be long-term tailwinds. And so right now, if we look at the local stock, RSI is quite low, but not oversold. Right now, the stock is under the 20 and the 50-day moving average. The 20-day one sits at $8.41, the 50-day one at $8.47, and the 200-day one at $11.58. So yeah, we've been around $8 or so for quite a while now, actually since the start of June. So let's hope that this stock can turn its momentum around and start making its way back over the 20 and the 50-day moving average. But still, the long-term future of this company depends on execution. And to be honest, with the new leadership, with the way they're showing the numbers, despite the headwinds, I think this company will do quite well. And of course, we might see a big jump in stock price in the next earnings report or two, if of course we see that margins have bottomed, growth rate reaccelerates, and then they're saying, look, our investment period is now done. Moving into next quarter and into 2025, you can expect free cash flow to reaccelerate and margins to expand. I think the stock will react quite positively on those comments. So that's company number 1. Of course, do share your thoughts down in the comment section below. Moving to company number 2, like I said, a company that is worth way more than the local and risk profile wise, very, very different. And that's LVMH. LVMH has a market cap of $330 billion. In the last 6 months, it's down close to 26% or so. The last year, as you can see, the stock has underperformed as well. It's down 14.8%. Now, this company is not expected to grow as fast as the local, but it is, of course, a much more stable company to own. Yes, it operates in the luxury industry, let's say. So when the economy worldwide is not doing that well, or especially not in China, then this company will get hit just like every other luxury stock out there. As you can see here, analyst estimates for sales growth in fiscal year 2024, basically 1.7%, not by much, and EPS down 2%. But then we see a reacceleration in growth in the next 2 fiscal years. Forward PE sits at 19.3%. Okay, not the cheapest stock out there, especially not if you look at those growth rates, but LVMH is one of those companies that, well, it's an extremely, extremely strong business and powerful company to go against. If you don't know what's under the LVMH umbrella, it's basically this. Since the start of the company, these are all the acquisitions that the company has made over the years. Various industries, various companies, various price tags as well, but you can pause the screen and look at all these companies that LVMH has acquired throughout its history. Now, over the past 25 years, this is basically the revenue growth per business group. So fashion and leather goods revenue 41.7 billion euros. That's 49% of revenue, and the 25-year CAGR sits at 13.4%. As for watches and jewelry, 13% of overall revenue, 25-year CAGR 26.4%. Wines and spirits, 8% of overall revenue, 25-year CAGR 7.4%. Selective retailing, 20% of revenue, 25-year CAGR of 9.3%. Then perfumes and cosmetics, 10% of revenue, and a 25-year CAGR of 5.3%. Now, the big news that came out today or tonight was that China unveils the biggest package yet to boost property markets. So the PBOC, or the People's Bank of China, government announces cut to outstanding mortgage rates. China also cut down payments for second homes to a record low. So the key points that you should know is this: a 7-day reverse repo rate cut to 1.5%. What's that? Well, a short-term interest rate at which the People's Bank of China borrows money from commercial banks. RRR reduction by 0.5 percentage points. What is that? That's the reserve requirement ratio, the percentage of deposit that banks must hold in reserve with the People's Banks of China. Potential MLF rate cut of 0.3 percentage points. MLF meaning medium-term lending facility, a lending tool used by the PBOC to provide liquidity to commercial banks. Then a 4-point reduced medium down payment ratio for second home buyer. So the impact here is an injection of 1 trillion won into the banking system, lower borrowing costs of up to $5.3 trillion in mortgages, liquidity support for the stock market, and a significant boost to the Chinese stock market. And so you've seen stocks like Alibaba, LVMH, especially luxury stocks, because China is a huge, huge market for luxury things. So you've seen LVMH have a little boost today. Now, in the first half, by the way, they don't report quarterly earnings. It's first half, second half. So in the first half, the results were good despite the prevailing environment. So revenue grew 2% year over year. Profit from recurrent operation was down 8% year over year, but they still have an operating margin of 25.6%. Operating free cash flow was 3.1 billion euros. That's up 74%. Operating investments, 2.7 billion euros, and net debt to equity ratio of 18.3%. If we look at their growth in different markets, United States is up 2%, Japan is up 44%, Asia excluding Japan is down 10%, and Europe is up 3%. Now, why is Japan up so much? Basically, Chinese customers going to Japan because the currency there was weak and buying the goods in Japan makes total sense. When I was in Japan, I felt like a very, very powerful buyer there because my currency was stronger than theirs. And so if we look at the different business groups and their performance, so wine and spirits down 12%, fashion and leather goods down 2%, perfume and cosmetics performed a bit better, that's up 3% year over year, watches and jewelry down 5%, and selective retailing was up 3%. So overall, total LVMH was down 1% on the reported growth, but up 2% on organic growth. If you deal in, let's say, watches and stuff like that, sneakers, or maybe wines and whiskey, you probably know that the market is a bit weak right now. And so a major overview of LVMH business, total revenue, free cash flow, gross profit over the last couple of years. As you can see right here, very, very strong business, big business that is growing despite some recent headwinds. But of course, it remains to be seen what happens with the world economy in the next, let's say, 12 months or so. Is the United States going into a recession? Yes or no? Same can be said about Europe. Let's see what really happens with China, if that will be enough to stimulate the overall economy and how long these effects will last. So you have to take all of that into consideration. But LVMH has been here for a long, long time. It has been here when the economy was much worse as well. It's all about, let's say, how much you're willing to pay for that company, how much you're willing to pay for that stock. And if you believe that the luxury goods market, luxury goods, you're talking here about wines, fashion, perfume, cosmetics, watches, jewelry, etc., if they are still going to be a thing in the years to come. My answer to that is yes, 100%. They're still going to be a thing. And a company like LVMH or Hermes, for example, because in my opinion, those are the two choices that you have to make. You either go with LVMH or you go with Hermes, extremely strong companies. I don't think you can go wrong with those. And so right now, if you look at the stock, RSI was pretty low at the start of last week, not oversold, but really, really close to being oversold. Right now, the stock sits, by the way, you can buy it in the Paris exchange or you can buy it in the United States in dollars as well. But as you can see, it is trying to go above the 20-day moving average. That is at $621, the 50-day one at $649, and the 200-day one at $714. So overall, that's about it for me in this video. Of course, do share your thoughts down in the comment section below. Do you own dLocal? Do you own LVMH? Are these interesting companies to you? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.